So one of the things I was thinking about in terms of, how can you show and get people to understand risk? I had a conversation with a professor of psychology, and we were discussing various experiments that had been done. He's not into trading as such, but I've been sharing my experiences with him in terms of issues that I've seen that people have. And the reason that we ended up joining up together is I was writing and getting into dialogue with this guy, and I was saying, here are all of the issues that I'm seeing, and these are the reasons that I think I'm seeing them. What do you think people need to do to overcome them? And can you parallel it to some other thing in life that it allows people to overcome some of these issues? But he was giving me loads of interesting advice and telling me about experiments that had been done that showed and exhibited characteristics that sort of mimicked the sort of things that I had seen. And when I came to the location I'm in at the moment, I checked into the hotel, went up to the wrong floor initially, and then decided to go down the stairs to get to the floor that I required. And it dawned on me that, in fact, when you're meandering around a hotel, it is a bit like trading a market. And I was wondering whether this metaphor would allow people to understand their objective and what approach that they require in a market a little bit better. But basically, when you're looking at a market, it'll move from here to there, and you're trying to sort of say, well, this is what I expect to happen. But in between those two areas, there's an awful lot of noise that takes place. And if you opened the market here and closed it there, and you didn't allow people to trade the bit in between, then what you'd probably find is that people would trade better because they would make one decision, they would stick with that decision, and that would be it. But what tends to happen is, as the market moves around, people just get shaken out of the market constantly. And if the price starts to move in this direction, then they panic and get out. And if the price starts to go up, they're feeling great. But then it starts to decline, so they panic and get out, only for the price to head back up again. Whereas when you look at the way that I trade a lot, it's relatively passive. It's not all blood and thunder and everything's going crazy. Now and again you do get the odd market like that, but generally I'm quite passive. I'm expecting to take a position, I'm expecting something to happen, and it sort of doesn't, so I don't panic about it. And when it's going well, I accelerate into the trade and do well from it. But when you look at people who are struggling, they get shaken out by the noise in between. So anyway, back to the hotel analogy. First of all, you've got to select the right floor. So there are a range of strategies that you can adopt, and you need to pick the strategy and then go to that floor. Because obviously if you go to floor 4 and your room is on floor 5, then that's just not going to work at all. So that's your first stage. That's what I would call the research, development and process side. You're looking to achieve a certain thing, but you need to be on the right floor to be able to do that. But when you arrive on the floor, imagine the following scenario. You don't know what your room is, but for every room that you go into, there is a reward. Now, sometimes you'll lose money, but in the rooms where there is a reward, that money more than offsets the potential loss. So you're standing at the end of the corridor, you're looking at all these rooms in front of you, and in the trading process, you know that if you get to the end of the corridor, there's a good chance that you will actually profit. Now, you can't visit all of the rooms. There's a catch here. You can't visit all of the rooms. But in the process of the duration of this market, i.e. walking from one end of the corridor to the next, to the very end of it, then you have to visit a set number of rooms. Now, a lot of these have money in them. And if you, in fact, visited all of them, you'd be net up over the whole experience. But there is a demonstrable chance that actually you may not make money by reaching the end of the, when you reach the end of that corridor. You could just be really unlucky and you just happen to choose the rooms that have no money in it. But from a trading perspective, that shouldn't stop you from progressing. That shouldn't stop you from continuing to move through the corridor. And what we're talking about here is the rooms are noise. So some of them contain positive experiences, some of them contain negative experiences. If you happen to visit all of them, then you'll have a positive experience overall. But it's interesting because experiments have been done, a variation on a theme, obviously not with hotel rooms, that have proved that people that have damage to their brain, that reduces their I'm just trying to think how to describe this. People who've had damage to the brain, which makes them fearless, i.e. they have no ability to recognize fear, tend to perform better on those types of experiments where you've got an equal number of rewards and that will end up positive than people who actually don't have that. So people who have no inhibition of fear tend to continue through the corridor and see it right through to the end up and tend to end up positive. But curiously, people who still have all of their facilities intact perform much, much worse. And what tends to happen is they go to the first door, they open it up, and there's no money inside. And they've had to sort of pay an entrance fee, effectively, to go into that room. So they're down on the deal. So they go to the next room, and there's no money in that one. And they've paid some money on both rooms, and suddenly they're looking at a loss. So in terms of the way the market works, this is the noise that you see, the chippy-choppy whipsawing of the market. Now, the fact is that if you walk from one end of the corridor to the other end, you will probably make money. You can't guarantee that you'll make money, but you probably will. And I know that, you know, in every market there is potential profit. So my objective as a trader is to get some of that profit at the lowest possible risk. But, you know, even if I use the best of my ability and skill, sometimes that won't happen. That's just the way the market works. But it doesn't stop me from pursuing it. But also, I'm very fixed in terms of what I'm expecting to happen. Now, when I can see that it's all going horribly wrong and I've misjudged it, this is important to say, that I've misjudged what I'm doing, then that's the point at which I'll change my mind and won't do anything. But if I still feel that all of the criteria are still intact, I will still pursue, and I will see the market through right to the end. But when you actually put people through this experience of walking through these hotel rooms, then the problem that you tend to have is that people don't see it through. They either stop when they've had a profit and it starts to tail off, or they have a few losses and they stop. And therefore that tips the balance of the equation all the wrong way around. So when I was trying to find my room here, I was thinking actually that's quite a good analogy for trading, because you stand at one end of the corridor, you know if you reach the other you will make money, but the only thing that can stop you from doing that is the process of opening all these doors. So necessarily, you know, I think that if you can get your head around that in terms of the way that you're looking at the market and the way that you're, you know, understanding what you're looking at within the market, that shouldn't stop you from pursuing your ultimate end game in that particular trade. But the problem is that it does stop a lot of people, and yet the market can be proven to be positive if you're choosing these particular strategies. And so it's only the process of opening the doors and having a positive or negative experience that is influencing your behavior. So I can't remember the name of this experiment that was done, but there was a very famous experiment that concludes that even in a fair game, people can still get it dramatically wrong. And listening to the description of this experiment and hearing the outcome of the results led me to the conclusion that it must be just fear of loss, that is the inhibitor to stop people from trading positively. And the funny thing is that even if you are on profit, the fear of losing that profit allows you to perform much worse than random. But even if you make a loss, which could turn into a potential profit, then people tend to take it for fear of a bigger loss. So you get trapped into this terrible mindset of not taking or not getting as much profit out of the market as you should do, because you know you have a bit of profit, you lose a bit, so therefore you take a smaller amount. And then when you get a loss, people panic and close their positions out too early. Whereas if you just manage to lengthen your time scale to something over a much longer period of time, then I think you would perform much, much better. So, you know, I've come to the conclusion here that there are a couple of themes that seem to run through some of the stuff that I've been looking at. And all that I need to do now is to try and find methods and processes that will allow people to probably overcome that. And I think some of them could actually be quite simple, but for the moment the work continues.
If you're interested in learning more about BetAngel, its tools and the opportunities they present, why not visit betangel.com today to download a free trial.